partner Jihan, we're going to explain about revenues and expenses. So first, I'm going to talk about revenues, which is based on PSAK 23 and IIS 18. So revenue is defined in PSAK 23 as an increase in economic benefits during an accounting period, which results in an increase of assets, a decrease in liability, and an increase in equity. And also, revenue does not come from a shareholder's contributions. So, in measuring revenue and recognizing revenue in PSAK 23, it is stated that revenue is measured at the fair value of the considerations of receipt or receivable. And the recognition of revenue from sales of goods, it is recognized when an entity transfers significant risk and rewards of the ownership, and the managerial involvement is also stopped, and the amount of goods can be measured reliably. Whereas in recognition of revenue from rendering of services, it's from the outcome of the transactions, which can be estimated reliably. And then in the reference to the stage of completions and at the balance sheet date. This is based on IAS 18. The revenue is defined as gross inflow of economic benefits during the accounting period, which is arise from the course of ordinary activities of an entity, and the inflow will result in an increase in equity. As we can see in this IAS 18, it is not stated that the inflows will result in increase for assets and decrease in liability as stated in PSAK 23. And then the recognition of revenue based on IAS 18 is the revenue can be recognized when transfer significant risk and rewards, and managerial involvement has been stopped, and the amount of goods can be measured reliably, economic benefits has been flown to the entity, and the cost can be measured reliably. So next I have a case example. So in here, contractor enters into a contract with a refiner to build an oil refinery on land refiner owns. So the contract has these following characteristics. The refinery is built to refiner's specifications, and also the refiners can make changes to the specifications over a contract term. The progress payments are made by the refiner throughout constructions, and also the refiner can cancel the contract at any time with a termination penalty, and the work in process is the property of the refiner. So the goods and services in the contract are not distinct, so the arrangement is accounted for as single performance obligations. So in this case, when should contractor recognize revenue of this contract? So in this case, contractor recognizes revenue as it builds the refinery because the performance obligations is satisfied over time. Refiner controls the work in process because any work performed is owned by refiner. And if the contract is terminated, it can make changes to the design specifications over the contract term.
So for the second part of this presentation, I will be explaining about the expenses, which will be based on the PSAK framework, and also I will be comparing the framework which is related to the IFRS. In regards to the definition of expenses, we can see that based on the Indonesian framework, the definition of expense is that it encompasses loss and expenses that arises in the course of the ordinary activities of an entity. This can be similar to the IAS 18 expense definition, in which expenses are decreases in economic benefits during the accounting period, or in the form of depletion or outflows of assets. This can be related to in the form of outflow or depletion of asset, which is stated in paragraph 78 of the Indonesian framework. In regards to losses can be defined as items that meet the definition of expenses, which may or may not arise in the course of the ordinary activities of the entity. This could include, for example, fire, flood, disposal of non-current assets. There's also a loss that is unrealized. For example, the influence of the interest exchange. This can influence the income statement of the financial statement. And if we can see that the IS 18 expense definition, the incurrences of liabilities that result in the decreases of equity relates to the opposite definition of what revenue stated, which states that the equity increases, whereas in expenses it decreases. In regards to recognition of expenses, according to IFRS, we should use the expense recognition principle, which shows that expenses should be recognized in the same period in which the revenues to which they relate. In recognition of expenses, we can see that there are three components. The first component is that we should associate cause and effect. This relates to the clear and direct relationship that exists between expense and revenue association. For example, cost of goods sold. For systematic and rational allocation, we can see that many costs cannot be directly linked to a specific revenue. Therefore, they can, however, be tied to a span of years and allocated within the expense of each of these years. For example, for systematic and rational allocation, we can use the expense of depreciation. For immediate recognition, some expenditure have no discernible future benefit. In this case, the expenditure is expensed immediately. For our case example, on May 1st, 2016, Company A borrowed $100,000 from a bank and promised to pay 12% interest at the end of each quarter. We can see that the recognition of expense is that the company has to pay interest expense for each month, and that in the end of each quarter they have to pay cash. So in June 30, they have to ensure that they have to pay cash, and in May and June they have to pay interest expense, as it is recognized immediately. So for the accounting treatment, we can see that in the May 1st, we can see that the company debits cash and credits borrowing from banks. In May 31st, because it is the end of the month, they have to pay interest expense and interest payable based on the interest that they have. And for June 30th, there are two accounts that they have to record. The first one is that they have to record interest expense and interest payable, which is the same as the previous month. But they also have to pay cash for both of the months, which includes interest payable and cash, resulting in 2,000 interest payable. So that is all for our presentation. Thank you.